Preparing for a financial analyst at Prudential Financial interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Tell me about yourself and why you want to become a financial analyst at Prudential Financial. I have built a foundation in financial analysis through coursework, modeling projects, and practical experience interpreting operating results. I enjoy turning complex data into clear recommendations, which is especially relevant to Prudential's insurance, retirement, and asset management businesses. I am attracted to the firm's long-term perspective, disciplined risk culture, and focus on financial security. This role would let me combine technical analysis with cross-functional communication while developing a deeper understanding of how financial institutions create durable value. While answering, connect your analytical background, accounting or finance skills, interest in insurance and retirement businesses, communication strengths, and motivation to support prudent decisions at a purpose-driven financial institution. Question 2. Why do you want to work for Prudential Financial? Prudential appeals to me because it combines a large, diversified financial platform with a clear purpose, helping customers achieve financial security. Its businesses require careful analysis of profitability, capital, market risk, and customer behavior, rather than a narrow focus on short-term earnings. I also value the firm's emphasis on inclusion, integrity, and long-term thinking. I believe Prudential would provide strong exposure to complex financial decisions while allowing me to contribute through rigorous, commercially useful analysis. Make sure to cover Prudential's scale, insurance and retirement expertise, customer-centered mission, long-term orientation, risk discipline, and how the role aligns with your development and analytical interests. Question 3. What do you know about Prudential Financial's businesses and sources of revenue? Prudential operates across retirement, group insurance, individual life, and asset management through PGIM, with additional international operations. Revenue economics differ by segment. Insurers collect premiums and earn investment income, retirement businesses generate fees and spreads, and asset management primarily earns management and performance fees. Results are also affected by mortality, policyholder behavior, market levels, interest rates, and credit performance. Understanding those drivers helps an analyst separate recurring operating performance from temporary market or assumption effects. In your answer, discuss Prudential's U.S. and international businesses, retirement, group insurance, individual life, and PGIM, while distinguishing premiums, fees, spread income, investment results, and market-sensitive earnings. Question 4. Walk me through the 3 financial statements and how they connect. The income statement records revenue, expenses, and net income over a period. Net income flows into retained earnings on the balance sheet, while the cash flow statement reconciles accounting earnings to changes in cash through operating, investing, and financing activities. The balance sheet must balance assets against liabilities and equity. For an insurer, I would pay particular attention to invested assets, policyholder reserves, deferred acquisition costs, and capital because those balances drive both earnings quality and solvency. Be sure to mention income statement profitability, balance sheet resources and obligations, cash flow reconciliation, retained earnings, working capital, and why insurers require additional attention to reserves, investments, and policyholder liabilities. Question 5. How would you analyze Prudential's quarterly earnings release? I would begin with consolidated and segment-level results, comparing actual performance with prior periods and expectations. Then I would bridge changes in premiums, fees, investment income, benefits, expenses, and net income. For Prudential, I would review adjusted operating income alongside reported earnings to isolate market-sensitive effects. I would also examine capital, sales, flows, assumptions, and management commentary. Finally, I would identify whether the quarter reflects a durable operating trend or a one-time valuation, reserve, or market movement. Focus on segment operating results, year-over-year and sequential trends, premiums and fees, net investment income, benefit costs, expenses, capital, management commentary, guidance, and separating recurring trends from market-related items. Question 6. What is the difference between generally accepted accounting principles earnings and adjusted operating income for an insurer? Generally accepted accounting principles earnings follow required accounting rules and include all recognized gains, losses, and valuation effects. Adjusted operating income is a management performance measure intended to highlight underlying business operations by excluding or normalizing selected market-sensitive and unusual items. I would use adjusted results to assess recurring profitability, but never ignore generally accepted accounting principles because it shows the full economic and reporting outcome. The reconciliation matters. Analysts should understand every adjustment rather than treating the non-generally accepted accounting principles measure as automatically superior. Explain that generally accepted accounting principles is the formal accounting basis, while adjusted operating income typically excludes or normalizes market-related and non-recurring items. Discuss usefulness, reconciliation, limitations, and the need to analyze both measures. Question 7. How do interest rates affect Prudential's earnings and balance sheet? Higher rates can improve future investment yields and reinvestment income, but they may reduce the market value of existing bonds and alter liability valuations. They can also affect demand for annuities, policyholder behavior, guarantee costs, and hedge results. Lower rates generally increase reinvestment and guarantee pressure, although they may support bond valuations. I would analyze asset and liability duration, spread income, capital sensitivity, and management hedging rather than assuming rates have a uniformly positive or negative effect. In your answer, cover investment yields, bond valuations, liability discounting, product guarantees, spread income, reinvestment risk, duration matching, hedging, and the differing short-term and long-term effects of rate changes. Question 8. What key metrics would you monitor for Prudential's retirement and insurance businesses? For retirement, I would monitor sales, deposits, net flows, assets under management or administration, fee margins, spread income, surrender activity, and capital usage. For insurance, I would track premiums, new business, persistency, mortality, morbidity, claims, expenses, reserves, and underwriting margins. Across both, I would review adjusted operating income, return on equity, cash generation, and sensitivity to markets and rates. The key is linking each metric to customer behavior, profitability, capital consumption, and long-term value creation. Mention sales, deposits, net flows, assets under management or administration, premiums, persistency, mortality, claims, expense ratios, spreads, return on equity, capital, and segment-specific operating trends. Question 9. Explain the difference between assets under management and assets under administration. Assets under management are assets for which the firm generally provides investment management or discretion. Assets under administration are broader balances serviced, recorded, or supported by the platform, even when another party manages the investments. Both can indicate scale, but AUM usually has a more direct relationship with management fees, while administration balances may generate service or record-keeping revenue. I would analyze net flows, market appreciation, product mix, fee rates, and whether reported growth is economically monetizable. Make sure to define both measures, distinguish investment discretion from record-keeping or servicing, explain fee implications, avoid treating them as interchangeable, and connect balances to flows, market movements, and revenue. Question 10. How would you build a financial model for a Prudential business segment? I would start by understanding the segment's economics and collecting several years of historical financial and operating data. Next, I would forecast key drivers such as premiums, flows, fee rates, investment income, benefits, expenses, and capital requirements rather than simply applying a growth rate to earnings. I would build base, upside, and downside cases, add sensitivities for rates and markets, and reconcile outputs to reported history. Finally, I would document assumptions and test the model for formula and reasonableness errors. Discuss historical data collection, operational drivers, revenue and expense assumptions, balance sheet and capital items, scenarios, sensitivity analysis, validation, and clearly separating management assumptions from analyst judgments. Question 11. What is embedded value, and why can it matter when analyzing a life insurer? Embedded value estimates the economic value of an insurer's existing in-force business plus adjusted net worth, generally using the present value of expected future distributable profits. It can help analysts evaluate long-duration life and retirement businesses where generally accepted accounting principles earnings may emerge gradually. However, the result depends heavily on mortality, lapse, expense, investment, and discount rate assumptions. I would use embedded value alongside statutory capital, new business value, cash generation, and generally accepted accounting principles results, not as a standalone valuation answer. Explain embedded value as existing business value plus adjusted net worth. Discuss present value of future profits, assumptions and sensitivity, limitations, and why it complements rather than replaces generally accepted accounting principles analysis. Question 12. How would you assess the quality of earnings at a financial services company? I assess whether earnings are repeatable, cash generative, and supported by core business drivers. I would separate recurring premiums, fees, spreads, and expense performance from realized gains, valuation changes, reserve releases, assumption updates, and other one-time items. I would compare adjusted and generally accepted accounting principles results, review operating cash generation and capital, and investigate unusual movements in reserves or deferred costs. Strong quality means earnings remain credible under normalized markets and do not depend primarily on favorable accounting or temporary conditions. Focus on recurring versus non-recurring earnings, cash conversion, reserve changes, assumption updates, realized gains, market sensitivity, segment consistency, capital generation, and reconciliation between reported and adjusted results. Question 13. Describe a time you found an error in financial analysis. During a reporting project, my forecast showed an unexpected margin improvement despite flat revenue. I reconciled the model to the source file and found that one expense category had been mapped to the wrong period. I traced the issue, corrected the formula, and asked a teammate to independently review the revised schedule. We then added a period-to-period variance check before submission. The experience reinforced that unusual results deserve investigation, and that simple review controls can prevent avoidable reporting errors. Tell a concise STAR story showing skepticism, reconciliation, root cause investigation, respectful escalation, correction, control improvement, and a measurable effect on accuracy, timing, or decision quality. Question 14. Tell me about a time you had to explain complex financial information to a non-technical audience. I once presented a forecast variance to stakeholders who were comfortable with operations but not accounting terminology. Instead of leading with technical definitions, I used a simple bridge showing volume, pricing, and cost effects, then translated each movement into its business cause. I highlighted the decision implication and kept supporting detail available for follow-up. I paused for questions and confirmed the audience understood the recommendation. That approach made the discussion more productive without compromising analytical accuracy. Emphasize audience assessment, simplifying without losing accuracy, visual or numerical support, business implications, checking understanding, and adapting communication based on stakeholder questions. Question 15. How would you evaluate an investment opportunity for Prudential's portfolio? I would evaluate expected return relative to risk, but also whether the investment matches Prudential's liabilities and portfolio objectives. My review would include credit quality, duration, liquidity, concentration, downside loss, stress scenarios, capital charges, and diversification benefits. I would assess the investment's cash flows against policyholder obligations and compare its risk-adjusted economics with alternatives. A strong recommendation would clearly state assumptions, major risks, mitigants, and the conditions under which the investment no longer remains attractive. Cover strategic fit, risk-adjusted return, credit or market risk, liquidity, duration, diversification, capital charges, downside scenarios, legal constraints, and consistency with policyholder obligations. Question 16. What is risk-based capital, and why is it important to Prudential? Risk-based capital is a framework that assesses how much capital an insurer should hold relative to the risks in its business, including underwriting, investment, interest rate, and operational exposures. It matters because capital protects policyholders, supports financial strength ratings, and influences dividends, growth, and strategic flexibility. I would monitor capital ratios, stress results, and available versus required capital, while recognizing that strong capital is valuable only when its composition and liquidity are also appropriate. Explain risk-based capital as a framework linking required capital to insurance, investment, market, and operational risks. Discuss solvency, ratings, dividends, growth capacity, and regulatory oversight. Question 17. How would you analyze a variance between actual and forecast results? I would first verify that actual and forecast data use the same definitions, periods, and scope. Then I would quantify the variance and decompose it into volume, price, mix, timing, market, assumption, and execution effects. I would speak with business owners to validate the operational explanation, distinguish temporary from structural factors, and assess whether the forecast needs revision. My communication would focus on the financial impact, root cause, confidence level, and recommended action rather than merely reporting a percentage difference. Mention confirming data integrity, quantifying the variance, decomposing price volume mix and timing effects, identifying controllable versus external causes, updating assumptions, and communicating actions and follow-up. Question 18. What would you do if a senior stakeholder challenged your analysis? I would treat the challenge as an opportunity to improve the analysis rather than defend it reflexively. I would clarify which conclusion or assumption the stakeholder disputes, then revisit the source data, methodology, and sensitivity cases. If I made an error, I would acknowledge and correct it promptly. If the difference reflected judgment, I would present both views, explain the implications, and recommend the most supportable conclusion. Respectful, evidence-based discussion usually produces a stronger decision and relationship. Be sure to mention listening carefully, clarifying the disagreement, revisiting assumptions and evidence, remaining objective, acknowledging errors, proposing alternatives, and escalating only when necessary. Question 19. How do you prioritize competing deadlines in a financial analyst role? I prioritize by considering deadline, business impact, regulatory importance, dependencies, and the cost of delay. I break larger assignments into milestones, protect time for quality checks, and communicate early if priorities conflict. For example, I would complete a time-sensitive management variance analysis before a lower-impact formatting request, while giving the latter a realistic delivery time. If two critical deadlines collide, I would clarify trade-offs with my manager rather than silently sacrificing accuracy or missing expectations. Discuss assessing business impact, regulatory or executive deadlines, dependencies, effort, quality risk, stakeholder communication, work breakdown, and escalation when priorities genuinely conflict. Question 20. What questions would you ask the interviewer about this financial analyst role at Prudential? I would ask what the most important deliverables are during the first 6 months and which decisions this role supports. I would also ask how the team measures analytical quality, which systems and data sources are most important, and how analysts interact with finance, investments, actuarial, and business leaders. Finally, I would ask about development opportunities and the team's current challenges. Those questions help me understand expectations while showing that I am focused on contributing quickly and building long-term expertise. Ask about first-year priorities, team structure, key performance indicators, systems and data, stakeholder exposure, development, review processes, current challenges, and how success is measured. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.